Hello and welcome to our latest Insider interview. I'm Kyle Caldwell, and today in the studio I have with me Thomas Moore, Fund Manager of the Aberdeen Equity Income Investment Trust. Thomas, thank you for coming in today.
Hi Kyle, good to be here.
So Thomas, we're recording this interview towards the end of 2024. It's been a very eventful year. Could you give an overview of portfolio activity over the year? What have been your most recent purchases?
Yeah, the first thing to say is we are spoilt for choice. The valuations are low, companies are seeing operational progress, but we do need to be mindful about the environment in which we're operating. The environment is choppy. We're seeing lots of macro variables. We're seeing the UK budget during October of 2024 causing an upward move in bond yields. That's had an effect. We've also had the election of Donald Trump. That's causing the dollar to rise. So we're thinking about the company specifics in the context of these macro variables. And where that's pointing me to with my portfolio is towards companies where I can got good visibility on earnings growth. Now, I'll give you a couple of examples. So companies where there's stability, like Galliford Try, the construction company, where they've already generated the vast bulk of their revenues on day one of the financial year because their order book is so long. It goes out well over 12 months. So companies like that with really good visibility on their order book, but also companies that are actually going to be beneficiaries of higher for longer interest rates. So NatWest, for example, will generate a really nice return just by sitting there with all those cheap current account deposits that they've got. They reinvest them at these gilt yields, which are now higher because of all this borrowing that the Chancellor is doing. Well, that's good news, funnily enough, for NatWest. So I can find opportunities, even in an environment where a lot of people are worried, understandably so, about the macro.
As we head into 2025, could I ask you to name one reason to be cheerful for the UK stock market?
Look, I am very positive about the ability of good companies generating strong cash flows to re-rate in terms of their valuations. You know, when you start at some of the lowest valuations across the developed world, so if you look at the UK and you compare it with all these other markets, if you compare it with the US particularly, you're looking at a PE ratio, price earnings, of about 12 times for the UK stock market. Now, the US market is trading on upwards of 20 times earnings. Now, obviously, sector composition is different, but even if you compare two companies like for like from the same industry, for example, Shell versus Exxon, you're going to see a huge difference in the PE ratio. So I'm very optimistic that UK companies are being managed well, can see their valuations re-rate. And we're beginning to see that across our portfolio in the last 12 months. We think that's got lots more to run.
And if I asked you to put your more bearish hat on, what would you say is the main risk for the UK stock market in 2025?
Okay, well, let's be realists as well. So it's important, you know, to talk up the risks here to the outlook. I would point to the upward move in bond yields post the UK budget, plus the national insurance increases as a headwind for UK domestic companies. We're having to be very, very selective about which UK domestic companies we select. The reason for that is that, look, investors who are tuning in today can choose to invest their money all over the world. And not every economy is doing tax rises and borrowing increases. That is going to have a dampening effect on UK domestic consumption in the short term because people will find that their pay increases are a bit lower, inflation's a bit higher, their mortgage rates are a bit higher. You know, all of that will dampen down the private sector growth, and that's called crowding out. That's the economist term for what is happening at the moment in the UK. Now, I think that that's a challenge for investors like me, but the fact that I'm able to select from such a broad range of stocks, I invest across the UK market. I'm looking all the way down to small caps, through the mid caps, all the way up to the mega caps. I've got lots of companies I can choose from to make sure that we're able to deliver for our shareholders in that tough environment.
I wanted to next ask you about interest rates. We've seen a couple of interest rate cuts in 2024. What's your view on interest rates in 2025? And do you think interest rates are potentially going to be higher for longer? And how does this all influence your stock picking decisions?
Yeah, so if you look at money markets, what they are pricing in, they're now looking at 1 or 2 base rate cuts in the next year. Now, if you compare that with 6 months ago, back in the middle of 2024, money markets were expecting 5 or 6 interest rate cuts. So that's quite a big difference. And that will dampen down the speed and the magnitude of the economic recovery that we see here in the UK. So we need to be mindful of that when we're investing. The good news is there are plenty of companies that can thrive in a higher for longer environment. If you think about some of the stocks in my portfolio, I mean, there are businesses that benefit from higher rates, either because they're generating interest income or because trading activity will be higher. So within financials, there are companies like TP ICAP, which is an interdealer broker. They thrive on higher for longer interest rates, and they love interest rate volatility. So that's the business that's trading its socks off at the moment. So look, we need to keep going through the portfolio, making sure that we're in the right place. I come in every day to the office with a blank sheet of paper mindset. I want to make sure that the portfolio is positioned correctly for each environment whilst we're picking those long-term winners.
And what's your overall outlook for dividends as we head into 2025? Are there certain sectors that you view dividends as being more dependable than others?
Yeah, absolutely. Look, dividend dependability is really important. And by the way, it doesn't mean we have to go low yield. I think it's really important to say dividend dependability can be the case for higher yielding stocks. Now, if you look at Imperial Brands, I'll give you that example. It's the largest position in the portfolio. For me, if you go back 4 or 5 years, the shares were languishing about £12, £13. They're now about double that level. Now, how has that happened? Because surely all high yield stocks are value traps, right? That's what the conventional wisdom is. That's what most armchair investors will tell you. I wouldn't touch it. The yield's a bit high. It's obviously a value trap. That was not the case in Imperial Brands. That's why we made it our biggest position, because we believed that the market was being far too pessimistic about the dividend dependability of a rock solid business like Imperial Brands. Sure enough, the dividend yield was 12, it's now 6, and that's because the share price has doubled.
In terms of investor appetite for the UK, we've seen for several years now there's been consistent outflows for UK equity funds. So what needs to happen for that to change?
It's a great question, and it's been years of investors pulling money out of the UK, and they're putting it all over the place. They're putting it into gold, they're putting it into US equities, they're putting it into fixed income. So it's been a long-term trend. Now, I would say there's actually a really natural way for this to sort itself out, which is that companies who are generating lots of cash, the kind of companies that I'm investing in my portfolio, they've got enough cash to pay their dividends. They're also buying back lots of shares. You know, the pace at which some of my companies are buying back their shares, there won't be any shares left soon. So I think that's the first point. Look, buybacks are really important because that will naturally stabilise the share prices of the UK market. And look, when that happens, that will in itself attract more buyers, because when share prices stabilise, surprise, surprise, people are more interested because the momentum is improving. And the second way in which the UK market could revive is M&A. So a bit like buybacks, if valuations are that low, companies will swarm to the UK. And we're certainly seeing that in my portfolio. I've had 4 bids in the last 12 months in my portfolio. DS Smith, Hargreaves Lansdown, Timon and Centamin across different industries. US companies, private equity are looking at the valuations on offer here in the UK, and they're saying, we see an arbitrage. We see our valuations up here. We see UK valuations down here. We see an opportunity. We're going to grasp that opportunity. And so if institutional investors and asset allocators are pulling their money, look, there's a flip side of that, which is that there's going to be more buybacks, there's going to be more M&A, and that will underpin share prices. And as I said, I think that will also help to sustain an improvement in sentiment towards the UK. And you know what? Performance begets performance. Flows beget flows. Once people start to become more interested in the UK equity market, it could get its own momentum.
And finally, Thomas, do you have skin in the game?
Yeah, my wife and I own Aberdeen Equity Income Trust as a meaningful part of our personal portfolio. And on top of that, My 4 children own it in their junior ISAs, so I've got them to answer to when they turn 18. As well, I should also mention that my elderly mother owns Aberdeen Equity Income Trust. And I think what's important about that is at an elevated cost of living, it's important for many investors to have access to that high dividend yield. I know she appreciates it. And I would also say that I've met many shareholders over the last 12 months, individual investors, who tell me that they appreciate the high dividend yield because that brings in cash that can help them to sustain their daily lives. So for me, that's one of the most heartwarming parts of the job is when I meet people, it's very motivational to hear that what I do can make a difference to them.
Thomas, thank you for your time today.
Thanks, Kyle.
So that's it for our latest Insider interview. We'd love to hear from you. You can comment, do hit that like button and also hit the subscribe button for more videos from fund managers. And hopefully we'll see you again soon.